Imagine waking up one morning to headlines of a crisis halfway across the world, a new sanction, a surprise policy shift. Your local market, which you thought was insulated, starts swinging wildly. Stocks fall, currencies wobble, and interest rates adjust. Suddenly, your portfolio feels vulnerable. You're left wondering, why is something happening on the other side of the planet affecting my investments here? That ripple effect is precisely what every investor needs to understand, because in today's interconnected world, no market is an island. So how does it work? Think of 5 main highways that carry global events straight into your local market. There's the trade highway. When the 2011 Japan earthquake hit, it disrupted auto and electronic supply chains for small manufacturers thousands of miles away. There's geopolitical highway. A distant war can cause oil prices to spike, directly hitting energy stocks everywhere. Then there's interest rates. The 2008 financial crisis started in the U.S. mortgage market, but it triggered coordinated rate cuts worldwide, changing local bond yields and mortgage rates from Sydney to Sao Paulo. There's currency. A global event can send your local currency soaring or plummeting, instantly affecting exporters and importers. And finally, there's investor sentiment. Fear drives capital to perceived safe havens, sometimes leaving perfectly good local markets undersold based purely on a feeling. It's like dropping a stone in a pond. The ripples travel across the entire surface. This reality busts that comfortable myth that your market is somehow insulated. It isn't. But here's the critical shift in mindset. Global events aren't just risks. They also create incredible opportunities. Widespread panic selling often creates bargains for the long-term investor who keeps a cool head. After 2008, quality stocks were trading at deep discounts. Think of these events like storms at sea. While some ships get battered, others adjust their course and discover entirely new trade routes. Being prepared determines who thrives. So how do you prepare? It's not about predicting the future, it's about having a framework, like a pilot's pre-flight check. 1. Use scenario planning. Don't bet on one outcome, model a few plausible ones and their potential impact. 2. Run a risk assessment on your portfolio. Which of your assets are most sensitive to a trade war, or a currency swing, or an interest rate shock? 3. Maintain global awareness but a local focus. Stay informed, but ground your decisions in local fundamentals. 4. Ensure diversification and liquidity. This gives you the flexibility to reposition when shocks hit. This isn't just theory. Investors who saw the global digitization trend during COVID positioned themselves in local tech for massive returns. When oil prices spiked from geopolitical tensions, smart money flowed to alternative energy locally. You can't control the turbulence, but you can adjust your altitude and speed to land safely. In the end, global events will always send ripples through your market. The key difference between a reactive investor and a proactive one is understanding the channels of influence, seeing the opportunities hidden in volatility, and having a plan. Stay informed, analyze your exposure, diversify, and think in scenarios, not certainties. Because in a world this connected, the smartest investors are those who can see the global ripples coming, anticipate the local effects, and act strategically before the wave even hits the shore.